Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. It's 2026, February 20th, and today's scheme is, the economy slowed, oil got spicy, and easy yield reminded everyone it can come with a lock on the door.
I love when the market does that thing where it whispers, diversify, and then immediately yells, surprise, everything is connected. Also, if your investment can't be sold when you want, is it an investment or a timeshare with better vocabulary? And somewhere in the background, inflation is doing the horror movie thing, where you think it's gone, and then it taps you on the shoulder. Let's go. I brought snacks and a stress ball.
Story 1. Multiple reports today highlighted the same headline. U.S. growth cooled at the end of 2025. The Q4 GDP print came in at a 1.4% annual rate, below expectations, and commentary also flagged stubborn inflation pressures in the same breath.
So the economy is slowing, but prices are still acting like they're late for a party. That's the worst combo. It's like your paycheck jogs, but your rent sprints.
Simple version of the finance. GDP is the economy's output, how much stuff we produced and sold. When it slows, companies tend to get cautious, slower hiring, tighter budgets. But if inflation stays sticky, the Fed has less freedom to cut rates quickly.
So we're stuck in the in-between, not booming enough for everyone to feel rich, not cooling enough for rates to chill. It's like the thermostat is broken and the house is arguing with itself.
Why it matters for normal people. If rate cuts get delayed, borrowing stays expensive. Mortgages, car loans, credit cards. If growth slows, job security can weaken at the margin. The actionable takeaway, keep your emergency fund boring and real, cash or true cash equivalents, because slower growth is when surprises happen.
Don't build your safety net out of high-yield, limited redemption, quarterly window vibes. If your emergency fund needs an appointment, it's not an emergency fund. It's a reservation.
Story 2. Oil held near a 6-month high after the U.S. warned Iran has limited days to reach a deal over its nuclear program, while forces in the region were reportedly being assembled. Markets price this as a risk premium. You pay more today for the chance tomorrow is worse.
Oil is the drama queen of commodities. It doesn't wait for the plot twist. It charges admission in advance. And then gas stations are like, we sensed you were having a good day.
Simple version, oil is a key input into transportation and manufacturing. When crude rises, it can seep into shipping costs, airline tickets, and eventually consumer prices. That's why geopolitical oil spikes can complicate inflation, just as the economy is slowing.
So it's like GDP is tapping the brakes, but oil is stepping on the gas, which is not how you want to drive anything, including an economy.
Actionable angle. If you're budgeting, assume energy costs can swing. For investors, remember energy is both a head and a risk. Owning broad diversification matters more than trying to nail the exact headline. And if you're planning travel or big purchases, build in a fuel surcharge buffer.
Also, if oil headlines stress you out, just remember, your personal hedge is boring efficiency. Drive a little less, combine errands, don't impulse buy a truck because it feels safe. That's not a hedge, that's a personality purchase.
Story 3. Private credit is back in the worry cycle. Reports described Blue Owl restricting withdrawals from a retail-focused debt fund and framed it as a potential canary in the coal mine for a crowded trade. People reaching for yield in assets that don't trade daily.
Nothing says relaxing passive income like discovering your money has business hours. Thank you for calling Liquidity. Your call is important to us. Please stay on hold until next quarter.
Simple version, private credit often lends to companies outside public bond markets. The loans can be harder to sell quickly. If lots of investors want out at once, funds may use gates, limits, or longer redemption windows to avoid forced selling at bad prices.
So the product is, you get paid extra for agreeing you might not be able to leave. That's not free money. That's a commitment. Like adopting a pet, but the pet is a loan to a company you've never heard of.
Actionable checklist if you're considering anything private or interval or limited redemption. 1. Match the investment's liquidity to your timeline. 2. Read the redemption terms. How often, how much, and under what conditions can withdrawals be limited? 3. Don't treat yield as a salary. Treat it as compensation for risk.
And if the brochure says stable, ask stable like a table or stable like a horse, because one of those can still kick you.
One more related data point. Bank of America's Michael Hartnett said U.S. stocks are drawing the lowest share of global flows since 2020. That doesn't guarantee a trend, but it suggests investors are at least considering rotation, international equities, cash, commodities, or alternatives, depending on the macro mix.
So the vibe is people are side-eyeing U.S. stocks, flirting with elsewhere. And meanwhile, private credit is like, don't leave me, I changed the locks. Romantic, but financially concerning.
Quick recap, Q4 U.S. GDP slowed to 1.4% annualized. Growth is cooler, inflation still a factor. Oil is near a 6-month high on Iran-related risk premium, which can feed back into prices. And private credit reminded everyone that higher yield can come with lower liquidity. Read the terms.
Your homework. Check your cash bucket, check your can I sell this on a Tuesday bucket, and then if you must chase yield, do it with eyes open, not vibes forward.
If this helped, subscribe and share the show. And drop a comment with the one headline you want us to translate into plain English next. BD Daily Finance News Podcast. Your daily briefing on finance and investing. See you next episode.
And stay tuned for the Should I Panic segment we never do, because the answer is usually no, but you should read the fine print. Bye.